We have breaking news. The Bank of Canada announcing today that it has cut interest rates. First time in 4 years that we've seen rates going down in this country. Just to reiterate, we had rates at 5%. We've come down by 25 basis points, with the Bank of Canada signaling there could be more easing ahead. We want to go live to Ottawa, where Bloomberg's bureau chief, Laura Dillon-Kane, has been covering this story. She just came out of the lockup associated with this Bank of Canada decision. Laura, what more can you tell us on the Bank of Canada's thinking, especially considering it now becomes the first group of 7 central bank to provide rate relief?
That's right. It has done so a day before the European Central Bank is widely expected to cut rates. So that happens tomorrow. You know, many markets and economists were expecting this cut, but others weren't. Others thought perhaps, you know, Tiff Macklem has been cautious before. He might want to wait to see a little more inflation data before cutting in July. But no, he said he has seen enough inflation progress at this point to decide that monetary policy does not need to be this restrictive anymore. And that forward guidance, I think, is really key. He said in his statement, which he's going to deliver to the press and to the public at 10:30, that, you know, although they don't want to jeopardize this inflation progress by moving too quickly, they also do see enough progress to say that, you know, there will be more cuts to come if inflation eases along this path. There are risks, of course. He highlighted global tensions, you know, the possibility that housing prices could spark, you know, much higher in Canada, as well as some other issues as being risks to the inflation outlook. But overall, you know, a very dovish statement, a signal that more easing is around the corner as long as inflation continues along this path.
We saw a quick reaction to this news, particularly in the currency market, where very quickly our loonie went down to session lows as the market is quickly assessing, obviously, our central bank's path compared to, for example, what happens in the U.S., where there are some who still aren't sure that the U.S. Federal Reserve will even cut interest rates this year. But it sounds like, based on what you're saying, Laura, the story of borrowing costs is TBD in this country. While certainly moving rates lower by 25 basis points might impact, for example, mortgages for some Canadians, the path lower in terms of borrowing costs still seems somewhat undecided at this point.
That's right. Governor Macklem has said in the past that he expects a gradual path to normalizing interest rates. So we could very well still see him decide to pause in July or pause in September. We may not see back-to-back interest rate cuts, you know, which some may want, and the inflation data may yet bear out that those are necessary, but they are open to taking a more gradual path, certainly. You know, there have been different estimates for how far the Bank of Canada can diverge from the Fed without creating too much downward pressure on the loonie. National Bank has said that the Bank of Canada could go as much as 100 basis points below the Fed. But Governor Macklem himself has said that, you know, there is a limit to how much that divergence can happen. So we will be sort of waiting to see the path of the Federal Reserve as it moves forward. But certainly their labor market appears to be loosening. Inflation appears to be starting to trend in the right direction. So, you know, the Federal Reserve is also still TBD, as you say. So we will continue to watch where things go from here, but certainly today providing at least a little bit of relief to struggling Canadian households.
Bloomberg's Ottawa Bureau Chief Laura Dillon-Kane, thanks very much. Joining us coming out of the lockup in Ottawa with this breaking news on the Bank of Canada. By the way, we'll hear from the Governor, Tiff Macklem. There'll be a press conference roughly 30 minutes from now, and we'll go live to that. Joining us here in studio, though, for a deeper dive on this pivot point, Warren Lovely, Chief Rate Strategist, National Bank Financial, Christine Tan, Portfolio Manager at SLGI Asset Management, and also joining us, Etienne Bordeleau-Labrecque, Vice President, Portfolio Manager at Ninepoint Partners. Thank you all for being here on a big day. Warren, your reaction to the bank's decision?
Well, it was just a question of when and not if the Bank of Canada was cutting. I think there was some legitimate debate in terms of whether we got it today or in July. So I think what the Bank of Canada is telling us pretty clearly is they've seen enough. They're not really, I think, declaring victory on price stability, but no question at 5%, the policy rate had been quite restrictive. We've seen progress on inflation. They have apparently seen enough to at least initiate what will likely be a gradual easing cycle.
Interesting. And Christine, we immediately saw some weakness in the Canadian dollar. How do you think the markets will interpret this announcement today?
I think the financial markets will probably see a bit of a relief rally, if you will, because of rates coming down slightly. On the Canadian side, it's going to be a bit of a mix because obviously we have a lot of commodities. The banks might see a bit of a relief given what's happening with rates. But ultimately, I think this was kind of our expectation to some extent. There was always a likelihood that it could be pushed to July. But the data has been quite weak. But more importantly, if you look at the Bank of Canada's quarterly surveys, the Consumer Expectation Survey and the Business Outlook Survey, it's been quite weak and indicating stress for 3 quarters now.
So I guess, Etienne, if we're trying to figure out the messaging from the Bank of Canada from here, what was your reaction on the path forward, on what they've said, which is still a bit cautious in terms of how far they go on rates?
Yeah, I guess the press conference is really where they can add a lot of color to this, and it's unfortunate we're having this discussion prior. So we'll see in about 30 minutes how much maybe they want to walk back some of these headlines. We've seen a lot of headlines about more cuts coming, and we've seen a lot less about them being still careful. So I think they want to balance that message really well. They don't want inflation, the housing market to start getting too hot again, and then undoing some of the hard work that has been done over the last two and a half years.
Which just the headline itself you think is enough to get people who've been on the sidelines?
We've been reading for the last 2 weeks a lot of news stories about people waiting on the sidelines, looking for real estate to jump back in. So I think that's the risk here, and that's really the last piece of inflation that remains too hot is housing.
And I guess, Warren, what on the flip side, what would be the risk having, if they had not made a move today, what's happening with the economy that was putting pressure on the Bank of Canada ultimately to make a move, even if some people read a headline and say, okay, I'm going to make my bid for a home now?
Right. Well, I mean, the Bank of Canada, give them some credit. They've been giving us a bit of a checklist in terms of what to follow. And I think what they've been doing is they've been filling in those boxes with check marks to get us to a cut. So in particular, what I think they've been moved by, influenced by, is pretty clear evidence that the real economy, GDP growth, is struggling under the weight of restrictive monetary policy. I think that's to some extent expected. We have an interest rate sensitive economy, after all, in Canada, a housing market in particular. But I think more than anything, what they're signaling got them to this cut here today, I think, is the inflation progress that they have secured on a momentum basis, and a bit more evidence that inflation relief is broader based. So I think, combined with some weakness in the economy and in conjunction with some inflation relief, they've seen enough now, making it, I guess, lucky number 7. Six meetings held at 5%, 7 gets us to the cut.
Christine, I guess for all central banks, but certainly the Bank of Canada, we got a couple of case studies on not only being late to the fight against inflation, but then trying to get ready for maybe arguably a pivot some time ago, only to see some of those inflation challenges reemerge. How do you think that's impacting the way they want to communicate, especially to investors like you?
I think that's probably the toughest question for the Bank of Canada. They've been historically more focused on leading data to try to guide your decisions, because there is a lag to monetary policy. This is the first time, to Warren's point, they've been so data dependent. They've given us a checklist, but more importantly, they seem to be more focused on hard data, which by definition is lagging to coincident. So it is difficult. I think they've learned maybe perhaps a lesson too much from the fight for inflation, where they were in the transitory camp for a bit too long. This time they're erring on the side of, in their view anyways, caution, of waiting. Because the phrase that we keep hearing, arguing for a July cut, was, what's the rush? What's the difference between June and July, except that maybe it gives you a little bit more confidence that inflation's on the right path.
Etienne, I just want to go to some of the commentary that we got from the Bank of Canada, because a big question coming into today would be, how would they describe the latest growth numbers we've seen for the economy, and they specifically on things like wage pressures, because I think we we've still had a somewhat resilient jobs market up until this point. I'm quoting here, but they seem to say that wage pressures remain, but look to be moderating gradually, and that overall recent data suggests the economy is still operating in excess supply. So they're pointing to some of the areas where we have still seen some solid growth, but maybe also sort of putting into that where we could be down the road to try to explain what's going on here?
Yeah, well, I mean, we've seen the labor market quite soft for the last, I'd say, at least 8-10 months. Wages have been really resilient despite the unemployment rate going up over 1% since the trough. So the last jobs report was really a head scratcher, 92,000 jobs added, unemployment rate flat. So the population, the labor force growth is very strong. So we need to see more slack in the labor market to see wages decelerate, but wages typically lag the slack in the labor market. So I think they have enough confidence now with inflation being where it is and inflation expectations, to your point, being where they are, that this wage growth will decelerate, will follow this weakness in the labor market we've seen so far.
And Warren, one thing we've talked with you about in your past appearances is our population growth story and whether or not that has just complicated how we read the data right now.
Absolutely.
Do you see it as a complicating factor?
Yeah, I mean, complication, distortion, we're in pretty extreme territory in terms of the population growth, the demographic impulse, I guess, to use another term, that we're seeing right now. So, you know, I think what it does is it adds uncertainty, it adds risk to the assessment of where the economy really is. We're having to do things like we don't normally think to do, which is, you know, look at GDP on a per capita or household basis to try to really understand and ascertain where the economy is headed. So I think what the Bank of Canada is telling us is that, look, they're data dependent. They've been encouraged by the data they've had. I think future decisions will continue to be data dependent and influenced by things like population growth, among many other things, including, of course, inflation.
And Christine, not that you're a political pundit, but I think we'd be foolish not to talk about the fact that you've had a lot of politicians in this country, both at the provincial level and even the Prime Minister, who have, I think, been crossing their fingers that we would see the Bank of Canada move towards lower interest rates. How they react to this, who knows? But how does that factor into the story? I mean, we're talking about in the U.S. even whether or not they can get some action on monetary policy in and around a presidential election, because the waters do sometimes get muddied when politicians are hearing from their stakeholders about their own frustrations around higher interest rates.
We were just talking in the green room about how being a central banker has never been this high profile. And to your point, you know, central banks are supposed to be independent, but they don't live in a vacuum. They're aware that there are pressures from both the population that they serve, as Governor Malcolm likes to say, but also they do hear what the politicians are saying. I would say they've done a pretty good job, that's my impression anyways, of being independent and staying above the fray. But they do watch the data. They are looking at what consumers are telling them about stress, and I think they do listen to what the banks are saying about their balance sheets. So to that extent, they are responsive, but I would wager that Malcolm probably just hears all these pressure, but he kind of steers above it.